Hey guys, welcome back to the channel. It's your host, Boss. And as always, we're diving into the wild underworld of economic mismanagement once again. Do economic moves in the US have you worried? Well, you're not alone. Today's hot topic is creating major waves in both political and financial circles, and rightfully so. A top economic advisor for Donald Trump has openly criticized the Federal Reserve for cutting interest rates during a sensitive time, right before the US presidential election. This gets to the heart of one critical question. Is the Fed really independent, or is there more political influence than they'd like to admit? Now, as usual, we are going to break this down from point to surface. We'll look at the central economic issues behind it all, layer by layer. This isn't just another news headline. This is a story about your money, the broader global economy, and yes, Washington's role in it all. We'll examine how the Fed's decisions might have real consequences for you, me, and the overall economic health. So get ready. Let's get into it. All right, let's start with the facts. In September 2024, the Federal Reserve made a pretty hefty decision. They cut interest rates by 0.5 percentage point. Now, a 0.5% rate cut may not sound like much to the average person, but in the jargon-filled world of central banking, this was a big deal. They don't usually make such moves lightly, especially when it's such a jumbo cut. So when heavyweights like Scott Bessent, CEO of hedge fund Key Square Group and close confidant to Donald Trump, start criticizing the timing, you know something's up. Bessent isn't just anyone throwing out opinions on Bloomberg News. This is a guy with deep knowledge of financial markets. His argument: the timing of the rate cut as the U.S. hurdles toward the next presidential election smells fishy. To be more specific, he suggests that making such a move so close to the election has tarnished the Fed's credibility. He basically laid out the issue like this: if you care about institutional integrity, then don't pull a move that big right now. And truthfully, many critics are echoing this concern. Let's back up for a second. Picture the Federal Reserve as the economic referee in a football game. Now imagine that this referee is making calls that seem to benefit the home team, in this case, whatever party is in power. Would that seem fair? Exactly. So, if we put this rate cut under the microscope, the idea is that the Fed should have waited maybe until after the November elections or into the following year. In times like these, timing is crucial. This sounds like a small issue, but as we'll see, it's indicative of larger, ongoing problems. So let's turn the dial on our focus. Why does this matter so much? What's really happening in the background? Let me explain exactly why a jumbo rate cut in an election year freaks people out. To the average person who's tuned out of financial jargon, you might think, well, 0.5 percentage point off the interest rate. What's the big deal? Well, here's the breakdown. Central banks like the Federal Reserve impact the economy through the federal funds rate, which either juices or reins in economic activity. Low rates usually translate to more borrowing by companies and consumers. It makes credit cheaper. Want a mortgage? Low interest rates say, go ahead, borrow away. Need to finance your business? Banks will lend at a lower cost. But there's a hidden dark side. Low rates over time often lead to inflationary pressure. Too much money floating around in the economy, and inflation gets out of control. This might sound familiar because, well, we've been living through years of this dance between inflation surges and the Fed trying to control it. Between 2021 and 2023, global economies battled skyrocketing inflation post-COVID, and interest rate hikes became the tool to manage this runaway inflation. But with inflation showing signs of softening, though stubborn enough to stick around, the Fed began cutting rates to stimulate growth again. So why now? Why this controversial rate cut? Given that inflation was cooling and unemployment was still relatively low, Bessent and a whole slew of other critics believe we didn't need such a cut right now, especially not in a politically sensitive environment. On paper, though, the Fed's move seemed grounded in stabilizing an economy that has started showing cracks. They reported that the labor market, while still healthy overall, had cooled down since early 2024. According to their internal projections, employment was expected to decelerate into next year, meaning less job creation, lower consumer demand, and potentially underwhelming GDP growth. But let's pause, because Scott Bessent and many others aren't buying the Fed's rationale. Sure, they can say it's about stabilizing labor, but is it really just coincidental that it's happening right before an election? Sounds suspicious. Let's talk about one of the Fed's core principles that makes this entire situation so critical: independence. The Fed is supposed to be immune to everyday political pressures, acting like a doctor overseeing the patient that is the economy, purely diagnosing what's best without any political bias. But political leaders, presidents, congresspeople, and even would-be world leaders often have their own desires. They want to see economic booms under their leadership. They want low unemployment, glowing GDP numbers, and a well-oiled economy in the months leading up to the next election to secure their re-election prospects. And who wouldn't? If you were a politician, you'd probably want to take credit for a great economy too. Trump, during his presidency and beyond, has been very open about this. In fact, Trump insisted during his administration, especially between 2018 and 2019, that the Fed should lower rates to stimulate more growth. Trump wasn't alone. Many political figures before him have wanted to have a bigger say in monetary policy to match their own electoral goals. But this encroachment into the Fed's independence is not just a U.S. issue. It's a dilemma echoed around the world, from South America to Europe to Asia. Now fast forward to 2024. Trump isn't even in office yet, but his advisor is already calling the Fed out for making what looks like a politically loaded move. Sure, Jerome Powell, the Fed chair, has said repeatedly that the Fed doesn't think about elections or act on political motives. In fact, Powell is often seen sweating under the lights in his high-profile FOMC meetings, defending the Fed's independence against any claims of political manipulation. But, as Scott Bessent has warned, perception often impacts the reality more than actual fact. Once institutional trust starts eroding, it's hard to win it back. And Bessent's criticism cuts to the bone of public perception. So to summarize this crucial point, Bessent isn't just angry that rates have been cut. His real concern is the optics. The appearance of political meddling, whether true or not, is toxic for an institution like the Federal. He hints that the Fed's reactive cuts could tarnish its neutral image at a time when America's economy needs stability more than controversy. We're teetering on deep debt ceilings, unresolved inflation concerns, and geopolitical instability. Playing with public trust in America's central bank just doesn't seem like a smart move. Something else that got a lot of attention lately is Bessent's idea of a shadow Fed chair. Essentially, Bessent wants Trump's camp to nominate a chair 6 months before Powell's current term ends in May 2026. This would throw a major wrench into Fed communication, which thrives on consistency and clarity. The argument: markets like stability and clear forward guidance. They respond well when they know what to expect. But imagine two voices in the room. Powell is still sitting in the chair, but a shadow chair is looming, whose future policies may not, and probably won't, align with Powell's game plan. This might sound like excellent political theater, almost Game of Thrones-esque, right? But it would be a disaster for financial markets, particularly the stock market, the bond markets, and currency flows. The Fed's signals would become murky, triggering volatility. The last thing anyone needs amid an uncertain global economic outlook. Mark Giannoni, chief U.S. economist at Barclays Capital, said it best in regards to the shadow chair idea. If the shadow chair isn't aligned with current Fed policies and starts signaling a different path for interest rates, it could spook investors and create significant market turbulence. Historically, we've seen that uncertainty in monetary policy sparks fear among investors, leading to stock market drops, currency depreciation ***, and higher borrowing costs for businesses and consumers. Imagine you're a household trying to decide whether to buy that home or start a business, but you have no idea what interest rates will look like in the near future. This kind of uncertainty leads to hesitation, which slows down economic activity across the board. The last thing we need is for financial markets and investors to feel shaky about the direction of monetary policy while already navigating a post-pandemic, inflation-riddled economy. Okay, so let's zoom out a little more and take a broader look at history. The issue of political interference in central banks is not a new story, nor is it unique to the United States. Let's take a look at some global examples and why meddling in central bank policy is a red flag for any country. Turkey, in recent years, serves as a near-textbook example of what can go wrong when central bank independence is compromised. President Recep Tayyip Erdogan's insistence on pushing for ultra-low interest rates, despite rising inflation, led to a series of economic calamities: spiraling currency depreciation, a loss of investor confidence, and significant outflows of foreign capital. The Turkish lira has been in free fall for years, and the country's borrowing costs shot through the roof. By the time inflation soared to well over 80% in 2022, it became clear that political desires to juice the economy through easy credit were unsustainable and damaging in the long run. Let's not forget Argentina, another striking example. Political interference in the decisions of its central bank has led to hyperinflation, massive currency depreciation, and repeated sovereign debt crises. Argentinian inflation soared past 124% in 2023, partially because political figures demanded low interest rates to artificially boost consumption, at tremendous cost to economic stability. Closer to home, even during Trump's presidency, there was concern about his vocal criticism of the Fed and Jerome Powell. In 2018 and 2019, Trump repeatedly lashed out at Powell for keeping interest rates higher than what he preferred, arguing that a lower interest path would spur faster economic growth. Trump even floated the idea of firing Powell or demoting him from his role. Such direct public criticism raised concerns globally that the Fed's independence was under threat, which could have led to wild swings in global markets if investors began to question the validity of U.S. monetary policy. Remember, central bank independence isn't just a bureaucratic talking point. It's a mechanism that anchors long-term inflation expectations. When that credibility is compromised, it leads to distrust in not just national but global markets because there's less certainty about future interest rate paths, inflation control, and overall economic stability. Now let's shift gears slightly and look at what the Fed is actually balancing right now. Critics like Scott Bessent are looking at the rate cut through the lens of political optics, but the Fed, of course, couches its decisions in terms of its dual mandate: maximum employment and price stability. So where exactly does the U.S. economy stand on these two goals, particularly in the context of why the Fed cut interest rates? After the COVID-19 pandemic, inflation in the United States shot up to 40-year highs, over 9% at its peak in mid-2022. Powell and the Federal Open Market Committee, FOMC, had to act with aggressive rate hikes to curb this spiral. The hikes throughout 2022 and 2023 took the federal funds rate to over 5.5%, one of the highest levels in recent years. These moves cooled down inflation, bringing it gradually closer to the Fed's 2% target. But the price for this effort was the prospect of economic recession and a slowing labor market. By mid-2024, inflation measures were closer to 3 to 4%, with the Fed eyeing more modest reductions, essentially declaring victory on the inflation front, but still needing to carry out a balancing act. The labor market started showing signs of cooling as well, with job openings decreasing, wage growth slowing, and companies holding back on hiring. Powell cited these softer signals from the labor market as a rationale for cutting rates by 0.5% in September, a preemptive move to prevent stagnation or recession. But here's the question: was that move necessary? Labor markets, while slightly decelerating, weren't showing extreme stress, and inflation was still above the Fed's 2% target. Many economists argued that the size and timing of the cut could send conflicting signals. Cutting rates too early, particularly when inflationary pressures are still present, risks reigniting pricing instability, something neither investors nor consumers want. The Fed's decision paints a broader picture of central banks trying to manage competing priorities. Economic indicators can be fragile things, and sometimes policymakers preempt trends that never fully materialize. It's a large gamble, but one thing is clear: monetary policy is no longer predictable, and the huge cuts made can signal panic rather than prudent long-term strategy. Now let's talk about how this has played out in the global financial markets and what it means for you, whether you're an investor, business owner, or simply a curious observer. The Fed's interest rate decisions don't just influence the cost of borrowing in the United States. They send ripple effects across the entire world. Financial markets are highly attuned to U.S. monetary policy due to the global dominance of the U.S. dollar and American capital markets. Right after the September 2024 rate cut announcement, stock markets initially rose. Why? Lower interest rates commonly benefit corporate earnings by reducing debt repayment costs for businesses, which boosts Wall Street's optimism about future profits and stock valuations. But the glow didn't last too long. Investors are savvy enough to understand that cutting rates, especially such a jumbo cut, signals potential concerns that the Fed might be seeing risks they're not ready to fully reveal to the public. Almost immediately after the bump, volatility returned. Over the coming weeks, sectors most sensitive to interest rates, particularly banking, real estate, and consumer finance, registered signs of strain. Banks saw their profit margins tighten, as low-interest environments reduced the room for making a spread on loans versus deposits. Meanwhile, in the housing market, previously skyrocketing property prices showed signals of cooling, since rising interest rates over the last few years had choked demand for new home purchases. Then there's the global stage. The Fed's decision to cut rates contrasts with monetary tightening in many other regions, particularly Europe and Asia, where central banks have been more focused on controlling persistent inflation. This created an environment where the US dollar weakened against other world currencies because interest rate differentials usually dictate currency flows. Investors started looking at higher-yielding currencies elsewhere, triggering the beginning of what forex analysts call dollar depreciation. The days of the dollar's meteoric rise in 2022 and 2023 seem to be over, at least for now. For businesses, especially those with global exposure or international financing needs, this may bring short-term relief. A weaker dollar can help boost U.S. exports by making American products more affordable abroad. But the long-term consequences are riskier. A weakening dollar may compound existing inflationary pressures, especially for imported goods, making it a headache later on for both the Fed and American households. Zooming out again, let's wrap this all together and return to Scott Bessent's core argument, that the Fed's actions are compromising its credibility as an institution. There's no question that the sheen of competency, neutrality, and reliability is the single most important asset a central bank like the Fed can possess. Once a central bank loses the trust of the markets, the people, or policymakers, it becomes very difficult to regain. So what do critics like Bessent suggest? Beyond criticizing the timing of the rate cut, Bessent floated the idea of delegitimizing Jerome Powell's leadership by appointing a shadow chair 6 months before the end of Powell's term in 2026. Let's be clear, this would be an unprecedented move. The idea here is that financial markets would shift attention from Powell to the incoming chair, eroding Powell's ability to effectively guide policy as his term winds down. But this raises a major question. What does such a proposal say about institutional stability? Normally, markets prize predictability and clarity. Any signal that sends mixed messages or fuels the perception that competing policy authorities, in this case, Powell versus the supposed shadow chair, are in place is a recipe for chaos. At the heart of Bessent's critique, and perhaps the broader Trump camp's argument, lies a dissatisfaction with how Powell steered monetary policy. But there's a far more dangerous precedent in questioning the legitimacy of the person holding the reins of the economy. The Fed might have made a dubious, ill-timed decision in September, but undermining its credibility over the long run, either by suggesting political interference or through dubious appointments, only snowballs into larger systemic risks. So, where does this economic saga leave us looking toward 2025 and beyond? The Federal Reserve now finds itself between a rock and a hard place. The pressure for more rate cuts will likely increase if economic headwinds persist, especially if growth slows further or the labor market deteriorates. On the other hand, if inflation remains sticky or resurges, the Fed will be pressured to pivot back to rate hikes, which could spook markets that are already on edge after recent actions. Here's what we're facing. 1. Economic growth and recession risks. The growth outlook for the U.S. economy has already started to soften. GDP growth forecasts for 2024 were already revised down by various institutions, including the World Bank and IMF, with expectations landing around 2 to 2.5%, a drop from previous stronger post-COVID recoveries. Slowing growth could easily manifest as a decelerating job market, decreasing household consumption, and faltering business investment, each of which justifies some Fed intervention. But critics like Bessent argue that the rate cut creates more medium-term risks than benefits. By cutting too early, the Fed may trigger financial instability or increase inflationary expectations, forcing their hand into sharper rate hikes down the line, which could easily push the economy into an outright recession. The market is very sensitive to this teetering dynamic. Too much growth dampens inflation expectations, yet too little risks pushing companies to cut jobs, slow wage growth, and decrease consumer sentiment. 2. Inflation staying elevated. Look, we've seen the ugly side of ignoring inflation in the past few years. Price levels for housing, food, energy, and consumer goods are still relatively high compared to pre-pandemic levels. While inflation has cooled from its peak, core inflation, which excludes volatile items like food and fuel, has proven stubborn. Critics of the recent rate cut argue that it might stoke the flames of inflation again, particularly if the labor market remains tight long enough to put upward pressure on wages and, ultimately, consumer prices. If that happens, we'll end up in a cycle of persistent, sticky inflation, forcing the Fed into a policy dilemma. whether to raise rates again, risking recession, or to let inflation creep up to potentially unacceptable levels. This is where institutional trust becomes precarious. Would markets view the Fed's eventual decisions as politically motivated or inconsistent with their inflation-fighting mandate? These are the very questions that Bessent's criticism alludes to. Should the perception of political influence cloud the Fed's real objectives? 3. Market and investor confidence. The stock market itself has been on a roller coaster, and this volatility will likely continue. Lower interest rates typically boost stocks, but uncertainty about the Fed's long-term plans leads to capital flight into safer assets like bonds and commodities. One startling consequence of this uncertainty is a likely increase in volatility indices like the VIX, often called Wall Street's fear gauge. Investors hate surprises, and hawkish to dovish swings in monetary policy can create confusion about where to place bets, whether in growth stocks or defensive assets like bonds and utilities. Early indicators show that the fallout from the September rate cut has been ambivalent thus far. Stocks initially rose after the announcement, but gains evaporated as investors began to contemplate whether the Fed was seeing a risk on the horizon that they hadn't considered. Going into 2025, if the Fed continues to cut rates or makes poor communication decisions, expect heightened volatility as institutional investors scramble to adjust to rapidly shifting policy frameworks. 4. Geopolitical influence and U.S. dollar positioning. Let's not forget the influence of global markets and geopolitics. The U.S. dollar is a linchpin in global trade and finance. If the Fed continues on a more dovish path when other central banks are still hiking rates or keeping theirs steady, we can expect further dollar weakness. While exporters in the U.S. might benefit from a weaker dollar, the wider implications are mixed. A weak dollar could encourage inflation once again by making imports more expensive, raising the prices of the foreign-produced goods U.S. consumers and businesses rely on. It would also potentially draw capital away from U.S. bonds and equities, especially if foreign investors see better risk-adjusted returns in markets like Europe, where central banks like the European Central Bank, ECB, may stick with higher rates for longer. The interconnectedness of the global financial system means any missteps by the U.S. could have wide-ranging consequences, shaking investor confidence not only in U.S. markets but in global ones too. U.S. monetary policy decisions don't exist in a vacuum. In today's highly interconnected world, what the Federal Reserve does trickles down to every corner of the global economy. The September jumbo rate cut and the possibility of more cuts down the line have ignited conversations about their global ramifications, especially as emerging markets and debt-laden countries brace for a new wave of economic uncertainty. Here's what's at stake internationally. 1. Emerging markets debt crises. As the U.S. dollar weakens following Fed rate cuts, heavily indebted countries, particularly in Latin America and Africa, that borrowed in dollars may face record-high debt servicing costs. Many emerging markets took on substantial debt in U.S. dollars during the low-interest rate era of the early 2020s, leaving them highly vulnerable to fluctuations in their own currency values. If the U.S. dollar depreciates, the tide turns, and many of these nations will struggle with mounting interest costs, exacerbating existing socio-political and economic challenges. A weaker U.S. dollar doesn't just affect debt repayment. It places strain on investment flows into these markets. Investors seeking safer returns may retreat, leaving emerging economies more exposed to capital exodus. Exactly the kind of volatility that brings long-term risks for financial stability. 2. Global trade imbalances. The U.S. is still a major importer of goods, and shifts in its monetary policy change the dynamics of global trade. Export-oriented economies like China, Germany, and Japan depend heavily on a stable and relatively strong dollar to maintain their competitive edge in price-sensitive global markets. If the Fed maintains lower interest rates, pushing the dollar down, those economies may suddenly find their export competitiveness tempered, contributing to wider trade imbalances and potential frictions in international relations. Additionally, one cannot forget the global supply chain disruptions we've already seen over the past few years. They still haven't fully resolved. Compounded by unpredictable Fed policy moves, we could see growing tensions over trade terms, combined with protectionist measures and costly currency interventions. 3. Eurozone responses. In the Eurozone, where inflation challenges remain despite ECB tightening, a dovish Fed might further complicate the European Central Bank's battle. It will place upward pressure on the euro, making European exports more expensive for international buyers. At the same time, it could also lead to an influx of capital into European stocks and bonds, as investors may look for safe havens in higher yielding and stable rate environments. What happens when the ECB is caught in a tug-of-war between fighting inflation while maintaining competitiveness in global markets against a weaker US dollar? This could ultimately force the ECB to reassess its entire tightening cycle, much to the detriment of businesses and consumers within Europe looking for an end to rising rates. The drama surrounding the Fed's recent rate cut in September 2024 and the broader controversy around central bank independence brought up by Scott Bessent tells a complex story. It's one that impacts financial markets, global trade, and even the average consumer. The stakes are high. Too much influence over the Fed, or even just the appearance of political meddling, could unravel years of carefully constructed trust between U.S. citizens, the Fed, and global investors. If the U.S. economic system starts to look like it's bending to political pressure, that sends a dangerous message to the world. Nothing is untouchable. As the U.S. heads into potentially more stormy political and economic waters in 2024 and 2025, businesses, consumers, and investors will need to keep an even closer eye on Fed actions. The consequences of monetary policy missteps go far beyond just the price of borrowing. They touch everything from employment to the price of goods and global stability. For the everyday person, it means staying informed and paying close attention to how political discourse influences economic policy. Don't underestimate the power of central bank trust. It's the cornerstone of stable financial systems. Whether you're about to buy your first home, start a business, or plan your next investment move, the actions of the Federal Reserve will have a ripple effect on your money, your opportunities, and your financial security. In the meantime, let's hope the Fed carefully balances its precarious path forward, because the integrity of one of the world's most powerful economic institutions is nothing to take lightly.